Welcome aboard the Pilot Money Guys podcast, where our mission is to help professional pilots build and protect wealth on their journey to financial freedom. This podcast is brought to you by Leading Edge Financial Planning.
Hey, Pilot Money Guys audience, Kevin and Andy here. We're actually recording this before the podcast begins in earnest with Hank Bessembinder. And we just wanted to introduce Hank as well as go through some of the most salient points that we felt were really important and define a few terms because we get pretty deep into it, Andy, when we have Hank on the podcast. The other thing I just want to say is I apologize to all the chartered financial analysts for making up a new designation. Andy is actually a chartered financial analyst. Did I get that right that time, Andy?
I think you got it. Yeah, nice.
All right. Good deal. So Andy, go ahead and do the introduction, and then we can talk a little bit about some of the most big takeaways we felt.
Yeah. It was a great podcast, great session with Hank. And so just for our listeners, a quick bio on him that I think will help set the stage. So we had Hank Bessembinder. He's a renowned professor at the Francis J. and Mary B. Labriola Endowed Chair in Competitive Business at Arizona State University. And Hank brings decades of expertise in market design, trading, and long-term investment performance. His insights have shaped academic research and practical strategists for investors worldwide. So a little bit about his career path. He returned to Arizona State in 2015 after teaching at Emory University, the University of Utah, and the University of Rochester. And his research spans stock, foreign exchange, fixed income, futures, and energy markets. His educational background is his PhD from the University of Washington, MBA from Washington State University, and then his bachelor's from Utah State University. And then the last bit of his bio that we talk about a little bit at the end of our podcast is he's got a private pilot's license. So he's also a little bit of an adventurer and a pilot. So very cool.
Yeah. Well said, Andy. And I'll just say that I came about his work when I was just doing some Google searches on, I had a couple of pilots that said, why not just buy some individual stocks? We know the ones that are going to go up. And so I started to do some research, and his academic research-based studies came up, and I found it really fascinating. And Andy, It was a real treat for us, I think, to get to talk to him. For me, I'm a fanboy of his, and I kind of stuttered a little bit when we first started the podcast because I was kind of impressed with him. But he's really quite a cordial and unassuming guy. So I was very impressed with that. But what were the biggest takeaways you think from the podcast, and what definitions do we need to define here?
Yeah, I think it was a great session. We spent a lot of time talking about his research from 2018 on, do stocks outperform treasury bills. I won't spoil the message for the podcast, but we talk about things like skewness, right, as a measure of the stock market outcome. In other words, not the performance drivers in the market are really positively skewed, meaning there are very few stocks that have really powered the market and driven market outperformance. So really, when we listen to Hank and what he says, the takeaway is you've got to be very skilled. He doesn't discount that there might be skilled investors out there, but you've got to be very skilled if you're going to embark on a path of stock picking to do better than just, say, owning the index or the basket of the entire market. Great takeaway.
Yeah, and Andy, I'll just add that with positive skewness, the real easy way to think about this is the winners, they win so big, so big that they drag the market or the index to higher returns than the average stock in the marketplace. But there's more losers in the marketplace, but the winners that do win so big that they drag the market higher. And that's really the concept I think we touch on. And that's why we think stock picking can be a very difficult endeavor.
Yeah, and he does the research to back up the kind of the intuition that we've talked about with a lot of our clients for a long time. Let's see, what else we talked about, Kevin? We talked about measures of returns. Right. And that was fascinating discussion. Things like sustainable rate of return. In other words, what return could you get from your portfolio to have the value be the same at the end of a defined period? So great implications for things like like sequence of return risk, sustainable withdrawal strategies, how to think about take money out of your portfolio. So I think that's just as fascinating as the first topic we touched on with Hank.
Yeah, yeah. And the final thing we go into is just leveraged ETFs about
Yeah.
single stocks. To me, this is
Yeah.
the wild, wild west. And anyway, we'll let Hank talk about that. And anyway,
Yeah.
Andy, thanks so much for this intro, and we hope you enjoy the podcast. Hi, everybody. This is Kevin Gormley with Leading Edge Financial Planning. Thanks very much for joining us on the Pilot Money Guys. Today, we have a fabulous guest with us, Hank Bessembinder. And Hank, we've already done your bio before meeting today, so we're just going to introduce you. Thanks so much, Hank, for joining us today.
It's my pleasure, Kevin.
Yeah, so we have Andy Christopher today, who's also a certified financial analyst, and so Andy's going to ask the tough questions today. Hank, I'm going to ask all the softballs. I'm a CPA, so that means I know a lot about history of numbers, but very little about what's going to happen in the future. But I'll ask some softball questions to you as well, and we look very much forward to hearing about your research and some of the items that our pilot investor clients can take from this podcast. So first of all, Hank, just a little confession. I learned about you doing a Google search, and I think this is kind of the best way that research can actually hit investors. And I did a Google search, and I searched for, should you invest in individual stocks? And then I searched again for other type of items. And finally, it came up, a study came up that was all about, do individual stocks beat treasury bills? And I went into it. I was fascinated by it. When I did look at it, there wasn't a lot of information out there. And now it's kind of blown up and become this big study that everybody has read. So can you talk to us a little first about like why you did the study, what was your thinking about it, and that kind of stuff?
Sure. In all honesty, it was a little bit of an accident. I've been studying the financial markets for like 30 or 40 years. And it's not like I woke up one day and said, today I should study individual stocks. So it was a little bit of an accident. It was another paper that's had a pretty big sample, thousands of stocks over many months. And for kind of techie reasons, we were studying continuously compounded returns. And I just happened to notice that the average continuously compounded return for this big sample was a negative number. Mm-hmm. And again, it's kind of techie why, but suddenly the thought entered my mind that it could be that a lot of these stocks are actually losing money over time, and decided I should dig into that. So I did dig into it. I found that most stocks, it's true, most stocks actually do lose money over time. And when I first compiled this, I actually wasn't even sure if I should write it up, because I thought I didn't know this, but other people must know this. But talking to a few of my colleagues, I found out, no, it seems like a lot of people don't know this. So anyway, I wrote it up, put it out there with that title, Do Stocks Outperform Treasury Bills? I'll confess that was strategic. That was kind of a marketing title. I mean, it is descriptive of the question, do the individual stocks typically outperform the low risk benchmarks? But since we know that for the overall market, we know the answer, I figured people, when they see the title, will just have to be curious about what is this guy talking about.
Yeah, well, absolutely. It was clickbait to me. And I don't know, you don't want your research study to be clickbait, I know. But I will tell you, Hank, as well, is after I found your study and I presented it to Charlie and a few of the other people on the team, I started talking about positive skewness. And my message wasn't very well received when I started talking about positive skewness. And we all had to go back and look at our statistic books to see what that meant. So like, do stocks outperform treasury bills? Can you talk a little bit about what you found?
Sure. So the central result is most stocks don't outperform treasury bills. And there's more than one way to measure outcomes, and we might touch on that later. But if I just did a fairly simple thing, what we call buy and hold returns, I got that a slight majority of stocks actually deliver negative returns, and then a slightly larger percentage failed to outperform treasuries. When I looked at things in terms of another measure that I called wealth creation, and just think of it as a size adjusted, or it's a dollar measure. So big stocks matter more than small stocks, which I think is fair, because in the real world, big investment positions are more important than small investment positions. When I looked at it in terms of wealth creation outcomes, we know that the overall stock markets have been tremendous wealth builders over the decades. But I found that you could attribute all of the net wealth creation to just 4% of the stocks. So that really caught people's eye. But as you said, you brought up the word skewness. The underlying issue is skewness. If I hadn't chosen that catchy title, the more descriptive title would have been something like "Long-term stock returns are positively skewed." But I'm not sure that would have caught people's attention as much, even with the same content. But ultimately, the issue is skewness. Just a quick description of skewness. It's basically that you have a relatively few really big outcomes that affect your average. And maybe the best thing is to compare it to something that a lot of people are already familiar with, symmetric distributions of outcome, like the normal. In the normal distribution, you're as likely to be 10% above the average or 10% below the average.
Sure.
In a skewed distribution, it's asymmetric. Doesn't look like that. You've got a few really big outcomes. Those pull the average up. And because a few outcomes have pulled the average up, most of the outcomes are below the average. Anyway, that's what we've got in stock market investing, particularly if you look at longer horizons. There's a lot of skewness in the outcomes.
So I'm going to try to characterize this for our pilot clients, and if I get it wrong, please do say so. James Bond was famous of saying, "Don't tell me the odds," and really, that's really what your work has done for us as investors. You've kind of helped show us what the odds are, and Jim Cramer is often chastised as being a poor stock picker, although he is on TV and he acts really confident. But when I read your paper, I said, well, no wonder it's so hard for him to pick stocks and be, better than 50%. The odds of picking stocks is less than 50%, right? Half of your stocks are going to be losers and not even have not losers, but have a return less than T-bills. Is that an accurate way of stating it?
Yeah, that captures it well. And part of what we want to take into account here is that you can capture the average by being broadly diversified. So that's a very reasonable benchmark to compare to, the average or the mean. And in a skewed distribution, most of the outcomes are below the mean. So unless you have some special knowledge, unless you know something the rest of the market doesn't, if you're just picking one or a few stocks at random, the odds are against you. The odds are you're going to underperform.
Yeah, my last question, then I'll turn it over to Andy about this, is so 4% of the companies, and I've used the phraseology, they drag their performance of the rest of the stocks. They kind of drag them with them to get the returns that the market gets. And so why not just pick the 4% of the stocks, Hank?
Well, it's a great strategy. I'd love to do it myself. Yep. The devil's in the details, trying to decide which stocks these are going to be ahead of time, and decide in real time. And that's, of course, devilishly tricky. Some of the people that listen to this will have heard of the theory of market efficiency. Mm-hmm. And that's actually a controversial theory. There's some evidence supporting it, some evidence that's harder to reconcile with it. I don't know if the markets are efficient. What I do know is it's competitive. If you're thinking about trying to identify ahead of time those stocks that are going to end up in that right tail, just keep in mind there's a lot of other smart people trying to do the same thing. It's not enough to be smart. You have to be smarter than the competition here. And that's not easy.
That's right. And you might be buying these stocks from CEOs that are selling them, and they might even have more information than you do. Andy?
No, that's fascinating work, Hank, and we love that you're able to share it for our audience. I think we've kind of danced around, but I'm an individual investor. For our listeners here, like the big takeaway that you would say for them, I think we've sort of danced around it, but what would be kind of your message to them?
I feel like I need to qualify this just a little bit because it depends in part on who the audience is. But as I understand, your audience includes a lot of professional pilots, and I think professional pilots would be an example of a group of people that I've brought up in the past. These are smart, ambitious people, but they're not specialists in stock picking. Mm-hmm. And as I said, it's competitive. For most people, the takeaway from my study is everything that you already heard about the benefits of being broadly diversified is true. And on top of that, the skewness tells us that if you venture away from that and form a concentrated portfolio, the odds are against you. So for most people, for the vast majority of people, including smart people who have other things to do, it just reinforces the importance of diversification. Yeah. For a relatively small set of people who might actually have the skills to win this competition, there's an argument for having a narrow portfolio. And if something I've said before, I'll say again, there's no point in being a closet indexer. What's a closet indexer? That's somebody who is so broadly diversified that they might as well be holding an index portfolio, but then charges their clients high fees. If you're going to be active, be active. So, if you've got a strong case that you have economic speak here, comparative advantage, let's just call it skill. You've got the special skill. Sure. If there's a strong case, you've got the special skill, then go ahead and get a narrow portfolio. Just recognize the odds are still tough. And this is not the thing that most people should do.
Yeah. Yeah. And I think about that, if the closet indexing and, I think if a listener today would think, well, maybe I should have 10% of this really active investor, but then 90% in these ETF index type products. Like, I think what would your perspective be on that? I mean, you may not be achieving that level of active share that you think is going to move that needle.
Like I said, I think for most investors, there's a strong argument for being broadly diversified. Now, taking a slice of your portfolio and being active, it depends. If you're not the stock picker yourself, you're putting your money with somebody else that you're hopeful is a stock picker or a good active investor. Making a small tilt in your own portfolio, well, it's better than putting all of your own portfolio into a few stocks. And, time will tell. One of the things to keep in mind is that there is a lot of randomness in the markets. So even if you have identified a skilled manager, there's still a good chance of underperformance just because of the randomness out there.
Yeah, it's fascinating.
Yeah. So Charlie Ellis, I think Charlie Ellis said that he would say that people could have like fund money account or stock picking account, and don't put any more money in it. And then once it's gone, don't put any more money in it. I think he had a hint of what you're talking about here, that picking stocks is so difficult. So when you say that it's possible for an active manager to beat, the indexes or beat the market, if you want to say that way, it's highly unlikely. But you've mentioned that your study sometimes is used by active managers as a reason to be active. I'm still having some difficulty, Hank, figuring out like how would an active manager use your data to be able to, I guess it's stock selection is what they would have to do to be able to beat the market. Is that right?
Yeah. Now, to be honest and not oversell, I don't think there's anything in my study or very little. I've tried to touch on a few things that might be of interest to these people, but I don't think there's much in what I've done that would tell anybody which stocks they should buy. What I do think where my studies become useful to some of the active people is that there's some of them who've long had this worldview that, look, there's only a few companies that really matter in the long run. And my study, in some sense, validated that worldview. Most of the value creation is coming from a few companies. So they like to point to that. There's still the question of who can identify, a better than on a random basis, who can identify with any degree of systematic success, which companies those are going to be. And, I try not to be dogmatic here because, I do think there are some investors with the right comparative advantage out there, and we don't want to dissuade them. As a matter of fact, the market, the economy needs some active investors that are willing to commit their capital to companies with good long run potential. But I think they're relatively few. The way I put it sometimes is there's more people who profess to be the next Warren Buffett then there are people who are actually the next Warren Buffett. And the difficulty for the rest of us is telling which is which.
Yeah, no, absolutely. And identifying those people before they become Warren Buffett as well. So, I'm going to ask you a softball question, Hank, because, I first thought maybe this is just a USA thing, and maybe it's not true in other markets, but I know you did a follow-on study. If you don't mind talking a little bit about your follow-on study and what it maybe showed you.
Yeah, sure. So the original study was based on U.S. stocks. And of course, it was a very natural question. Does this hold outside the U.S.? And I might mention that, I was among the people who was surprised at first. But I spent some time kind of thinking through the underlying mechanics, the underlying principles at work. And I had become, in my own mind, quite convinced that this is a universal phenomenon. That entrepreneurial investing in markets with random outcomes are going to end up with skewed distributions. Some people in other fields refer to this. It's not exactly the same thing, but very closely related power laws, which would show up in a lot of places in society. Anyway, I'd become pretty darn sure that when I went to the global data, I was going to find something similar. And when we went to the global data, we found essentially the same finding, and maybe even a little bit stronger, maybe even a little bit more skewness, a little bit more concentration of the positive outcomes in a few stocks. So it's global. And backing up a little bit, I've never personally studied the private markets, private equity, venture capital, but it's always been the conventional wisdom in the private markets that most of your investments are going to be losers. The most common outcome is going to be losing all your money, but there's going to be a few 10 baggers or 100 baggers that sure. make the whole exercise worthwhile. And it's because it's the same underlying fundamentals that what happens when you compound random returns over time, you get this skewness.
Yeah, no, absolutely.
I guess, yeah. I was going to say that's fascinating because I think we think there's something magical that happens when a company IPOs and they become publicly traded, but your research would sort of suggest that those characteristics maintain throughout.
Yeah, the basic mechanics of entrepreneurial investing and compounding of random returns. I might add, one of the reasons I think this surprised people is maybe you've somewhere along the way taken an econ or a finance course where somebody went through time value of money and they show you compounding. They show you this nice smooth increasing curve over time. Well, that's compounding with no randomness in the outcomes. Mm-hmm. Compounding with randomness, with random outcomes is not nearly as intuitive. And, for people who have thought long and hard about it, some people, when I first came up with this, said, yeah, of course. These were people who had thought long and hard about it before. So it's in the mechanics of compounding random returns. You get the skewness. Forecasting the future is always difficult. But I feel confident saying, I can't tell you which stocks are going to end up in that right tail or the left tail for that matter. But I'm really confident saying there will be skewness in the future as well.
Yeah.
Andy, you want to continue on?
Yeah. I think one of the things we looked at or your research would, the whole market. Did you notice anything from small cap versus large cap? How does the size factor into the skewness in the portfolio?
Yeah, size is actually pretty important here, although size is proxying for something more fundamental, which is volatility in returns. Anyway, the empirical fact is that the skewness is strongest in small stocks, and it's still there, but considerably less in large cap stocks. Now, the underlying issue, and I had kind of reasoned this out in the original paper with some simulations, but there's a couple of econometricians in Sweden who, much better mathematicians than me, worked out the math in great detail. And they showed that the main driver of how much skewness you get in long run returns, compound returns, is the volatility of the short horizon returns. And once you see that, it just follows naturally. Small stocks tend to be more volatile. They also tend to be more skewed. Also, global stocks are a little more volatile than U.S. stocks. So again, that kind of explains why we found a little more skewness internationally.
Yeah. The size, I think that makes sense. Anything your research suggests on why global would have kind of more volatility or more skewness?
I think it's probably the characteristics of the companies themselves. I mean, to the extent that the financial markets are working as they should, volatility and returns should be related to uncertainty in the underlying economic fundamentals, the macro conditions, and also the uncertainty about the cash flows of the firm itself. So I think it's kind of intuitive that outside the U.S. things are a little more volatile than in the U.S. At least in past decades. We might be in uncharted waters today.
Well, and that's the truth. We do hear from some of our pilot clients that say, "Look, I just want to buy some tech names." So because the tech names in the U.S. have just really crushed it the last, I don't know if it's 14 years now, however many years it is, until this year, where foreign has done better. But what about like just picking tech names as opposed to like oil companies or something else? Is there any data that you can cite concerning that?
Yeah. So since the original study, I've done kind of a handful of follow-up studies. And let me just mention, if anybody wants to find the studies themselves, they're all available free for public download at the website ssrn.com, Social Science Research Network.com. You can do a search on me as an author and find any of the studies. But one of the follow-up studies I did is just to look at things by industry. And it's true that, when I create the leaderboards, and one of the things I've found, maybe not surprising, is the world loves leaderboards. They love lists of winners. I've also got some lists of losers too, but somehow those never get as much attention. But anyway, people look at the list of leaderboards and say, wow, there's quite a few tech stocks here. So I said, well, let's see if this is systematic. And the answer was it's not. Technology stocks are not the most likely stocks statistically to end up in the right tail. What's going on is that we have these tech stocks that ended up in the right tail, which are all household names. What we don't have in mind is the thousands of tech stocks that did not end up in the right tail.
Yeah,
never became part of our consciousness and have faded away.
Yeah, for those on YouTube, I just showed one of the I guess it's an infographic. I don't know what it's called exactly, but this does show like what you were talking about, like the winners, how amazing the winners have done, Hank. And yeah, I mean, I found this to be extremely helpful for me. Did you create this, or did someone create this with your work?
Someone curated it with my work. So my employer, the W.P. Carey School of Business at Arizona State University, helped to publicize this research. And even now there's a web page devoted to it that has that infographic. Also has links to some of the underlying data. Like, if you're curious about seeing how every one of the 29,000 common stocks that's ever been listed in the U.S. has performed, there's an Excel spreadsheet that can give you the answers on that website as well.
Yeah, well, no, that's great, Hank, because a lot of times we'll talk about markets, we'll talk about different funds, and people's eyes will start glossing over. And then we'll talk about an individual stock, and people get very excited because they know the company and they know their products. And so that can be really helpful to educate ourselves by using winners and losers. There's going to be losers if there's going to be winners. And Andy, do you have any final thoughts on this paper, or questions that you think our pilot audience might be interested in?
Yeah, one of the things that struck me was just the life of a stock, if you will. And there's, if your research, right, I think people think there's this, well, we think about companies as being in perpetuity, but of course that's not true. But kind of what did your research suggest on like the average stock life, and maybe kind of those common reasons why they may delist from a stock exchange?
Yeah, sure. So this is also something that surprised me, but let me put this in context a little bit. I'm using a particular database. It's put together by the Center for Research and Security Prices, or we academics all call it CRISP, just for its acronym. So I'm using the CRISP database, but CRISP endeavors to capture all of the publicly listed common stocks in the U.S. So I think the latest version I did, there was somewhat over 29,000 stocks that have been listed in the U.S. In any event, the CRISP database has return data for all the time that the company is listed. So I can go into the data and I can say, well, how long has a company been listed? And of course, some 4,000 of them are still listed, and the life is getting longer every day. But in any event, I can look at the average amount of time that a stock's in the CRISP database. And I was surprised that the median amount of time that stocks are in the CRISP database is less than 8 years. Now, that's in some cases, that's because they only listed recently. But in many cases, that's because they delisted. Now, why do so many stocks delist? It's a mixed bag. Roughly speaking, stocks can delist for reasons that are negative from the investor perspective, that they no longer meet the exchange's listing standards, which is almost always bad news. Either the share prices got too low, or they failed on reporting requirements and such. So they could delist for negative reasons. And if I single out those stocks that did delist for negative reasons, no surprise, terrible performance for the most part. But they can also delist for positive reasons, with the most prominent being that they were acquired by somebody. They were in a voluntary merger, or they were acquired by somebody, which is very typically good news for investors. And as you might guess, for those stocks, long-run performance is good. Of course, you don't know those things until after the fact.
Yeah.
But stocks come and go. I think psychologists call it availability bias. We are very familiar with some companies, but there's a reason we're very familiar with them. They tend to have been very successful, and many of them been around for a long time.
Excellent.
So Hank, a couple areas I'm just curious about for future study. One would be direct indexing. That seems to be the next thing that at least the companies are promoting. There can be some goodness in that with taxable accounts, lost harvesting, et cetera. So, but if you don't own those companies because you're harvesting losses, I think it's more of a long-term skewness than a short-term issue. But any initial thoughts on that, just about direct indexing and how it might affect markets?
Well, just a little bit. I've been teaching finance courses for about 40 years or so, and some of your audience will have taken a course like this, some not. But we typically teach the benefits of diversification, which is really important lessons. Some smart people have called it the one free lunch, the one exception to the no free lunch story, the risk reduction you can get from diversification. So that's a really important thing. And then we usually follow that up with a particular model, the capital asset pricing model. And we usually we just kind of continue it and we say, and this model implies that if you're going to be diversified, you should diversify all the way into, quote, the market portfolio. What's the market portfolio? It's a value-weighted portfolio of all the stocks out there. The logic for diversification alone didn't say that's exactly how you should diversify. It was this particular model, which is an economic model, which could be right, could be wrong. The logic of diversification is there in any case. Anyway, where I'm headed for that is that market value weights are not necessarily the only way to diversify. And, lots of people have concentration risk in mind these days with, the so-called Magnificent Seven now being a very large percentage of the overall market. And I'll just say, I don't give investment advice, but I'll just say that, having value weights is not the only way to effectively diversify. And, a case could be made that you're more effectively diversify if you somewhat downweight the biggest stocks.
Sure. Maybe I'll follow up there. I'll stay in the classroom a little bit because I think in finance courses, when we talk about diversification, there's always that chart that essentially shows idiosyncratic risk and the number of stocks you own, and it says, hey, you own 30 to 50 stocks, you've eliminated market or undiversifiable risk or idiosyncratic risk.
Right.
To me, that still seems counter to kind of what your research is suggesting.
Well, I don't think I've overturned that. I just think there's a few more things that can be, we can think about a few more things on top of that. So it's still the case that if you pick 30 or 40 or 50 stocks from broadly different sectors of the economy. I mean, you wouldn't want to pick 30 stocks from the automotive sector, the manufacturers and their suppliers, because the correlations would be high. But it's still true if you pick 30 or 40 or 50 stocks from across the economy, you're going to get a lot of risk reduction. But I'll just add two things to that. One is the graph that's usually shown is based on returns measured over short horizons, maybe monthly, maybe annual. I've got in one of the follow-up papers, I show that if you actually let returns compound for 10 years, it's not quite as effective, and you start to get the implication that maybe it should be somewhat more than the 30 to 50 to get most of the diversification benefit.
Yeah.
So that's one qualification. But the other one is skewness. And, I don't really know if we should call skewness a risk. It's a property. It's a feature of stock returns. You may have heard the phrase skewness preference. Again, that's econ speak. But it's just basically saying that some people like this idea of, even if it's a small possibility, the possibility that I could get 10x on my investment or even 100x on my investment and are willing to go for it. People, we call it skewness preference. We also call it gambling preference. You see the parallel.
Sure.
Anyway, some people like skewness, so I don't know if we should call it a risk, but it's a property. But whether you like it or dislike it, recognize that it's there in the long run, and recognize that it means that most of the outcomes will be below the average. Now, we already touched on the main determinant of long-run skewness is short-run volatility. But as long as there's volatility, you've got skewness. Okay, so diversifying will reduce your long-run skewness. So that's a lesson. And 30 or 50 stocks will reduce your volatility quite a bit, but you still have skewness. So you can't diversify away skewness.
Fascinating. Yeah.
So
just real quickly, I do want to get in there. You can reduce the skewness by diversifying, and you will reduce the skewness by diversifying, but you can't eliminate it.
Yeah.
So Hank, we wanted to now touch on about how to measure returns, and you've done some work on that. I think there's a paper out there that Andy read, so I'll let Andy ask the questions. But Andy, do you want to talk a little bit about measuring long-term returns and that kind of stuff?
Yeah, I think this Hank was the Financial Analyst Journal paper on how should investors' long-term returns be measured. So maybe I'll just kind of pause there. And we don't put a lot of thought on that. We just think the returns are the returns, and of course that's not true. There's lots of ways to measure that. But maybe how did you think about that, and what drove you into that research?
So in some sense, that was a natural progression because I started with that first paper, I guess, 8 or 9 years ago now, measuring long-run outcomes. And, along the way, just kind of morphed into, well, are we really measuring things correctly? And some of this thought process came from, people's questions. They say, well, have you considered this? Have you considered that? And over time, I'm thinking, well, there's more things we should consider. I might mention real quickly, so there's the paper that came out in Financial Analyst Journal earlier this year, and then there's a less technical summary of that I just posted within the last 2 weeks. It's just called it Measuring Investor Outcomes. It's also on SSRN, so if anybody who's listening wants to read it, maybe they prefer the less technical version. But I've come to the viewpoint that I don't think we're doing a very good job, or at least, no, we're not doing everything we could be doing to measure investor outcomes. I think the best that could be said is the sort of things that we most often focus on, and particularly among academics, but in the investment world, people who have adopted the academic measures, things like alphas and Sharpe ratios are based on arithmetic averages, simple averages of returns. Simple average return comes from summing the returns and then dividing by how many you had. In a world with compounding, summing the returns does not capture the experience. And the intellectual foundation for measures like the Sharpe ratio and alpha are in the capital asset pricing model, which we teach in all our basic finance courses. But that was explicitly a single period model. So who is the investor that a single period model applies to? That's somebody that you invest for one period, whether it's a month or a year. You invest for one period and then you're done. That's who these measures are directly applicable for. So I think the case that we can potentially do a better job of measuring investor returns is a strong one. So the paper kind of goes through a menu of alternatives, and we can touch on them each in turn. But that's the basic idea. Can we do a better job of measuring investor outcomes?
Yeah, I think the paper did a great job in your research of, you say walks through arithmetic, geometric, IRR. And then I think what you kind of lead into really is this idea of a sustainable return concept. And so maybe kind of help our listeners. What does that do for you? What does that mean from a long-term measure of return?
Sure, sure. So the paper, both the one in Financial Analyst Journal and the less techie version, they kind of first start with some things that are already out there. A lot of people won't be familiar with them because it's really scattered, and in some cases they really haven't got much attention. But it starts with some things that are already out there, and you touched on them: geometric mean, internal rate of return, also called the dollar weighted return, modified versions of that. But then my co-authors and I, we introduce what we think is a notably different way of thinking about return measurement. And the typical measures either implicitly or explicitly have in mind that all you care about is the size of your portfolio at a future date. And, if I wanted to put a pejorative spin on it, I'd say it's all about the size of your portfolio on the day of your demise. And phrased like that, I don't think there's very many of us that say, well, that's why we're investing.
Yes.
Okay, well, so why do we invest? Okay, well, we really do invest because in the future, we'd like to be able to make some withdrawals to fund the things that we really care about, which is not our portfolio balance. That's a means to an end, not the end. So this thing we call the sustainable return is it's a return measure, and like the investment world is a risky place, so it's going to be a random variable. You only know it after the fact. So with those qualifications in place, it's a measure of investment performance that focuses on the stream of withdrawals that could have been taken out of the account. And the specific formula that we present says it's the stream of withdrawals you could have taken so that the final value of your account is the same as the initial value of your account. And that's where the sustainable part comes from. You haven't eaten your seed corn, so to speak.
Sure. Yeah.
Let me try to ask this question as somebody who's a novice with this idea here. So it's not just about having the biggest number at retirement or some future date. It's about being able to live off your money in retirement, I think really is what we're talking about here. So our pilots must retire right now at age 65. So Hank, I think what you're getting at, and tell me more about this, like if a pilot is going to live, the pilot and their spouse might live 30 years. There might be better ways to measure their performance, or there might be better portfolios to be in during that time period to be able to live off their wealth. Is that really what you're getting at?
Well, I'm trying to go that direction. And
okay.
I would describe this as, I think my co-authors and I have just scratched the surface of something with more potential. Mm-hmm. And, this isn't false modesty. I only have modest mathematical skills. It's all relative, of course. But I have some math skills, but not the world's best. One of the things we're trying to do is nudge other smart people to think about these issues too, because we don't think we can solve all the problems or say everything that can meaningfully be said. Mm-hmm. And it's Kevin, an obvious application is retirement, but we think these tools are also really. We think these tools are relevant, say, for endowment managers. Whether you're managing a university endowment or an arts charitable endowment, they face the same sort of things. But we're basically trying to get people to think differently. We provide a specific formula. And I think the biggest, we're not the first people to think about, well, how do you make your retirement money last? But sure. Most of the prior work, including the 4% rule that gets a lot of discussion, is based on numerical simulations. Let's just go into the data and do a bunch of what if we had done this, what if we had done that. This is an actual formula that people with the right skills can sink their teeth into, and we think that will also have some potential. But it is ultimately about the question of what sort of withdrawal sequence can be supported by investments. So we think it has potential to help people work through these difficult problems.
So the issue of like liability matching and about taking out of the right investments, is that part of this or not?
I don't think, at least so far, I wouldn't be able to identify that this helps you pick your investments. But I think it's a tool. It's a tool that hopefully has potential. It does highlight, and maybe Andy, you were about to ask me. It does highlight what we're calling, and I think other people have also called, return sequence risk. Mm-hmm. So this was something I had heard about but hadn't really appreciated, and it's kind of interesting because as a professor, I've been invested for a long time with a company called TIAA, Teachers Insurance and Annuity.
Sure.
I recently received a brochure from them that was titled "Understanding Sequence of Returns Risk," and I've also come relatively recently to the viewpoint that this matters. And I've been talking to some academic audiences, and I'm about to basically walk them through why this matters. But I survey the audience. I say, how many of you ever heard of sequence of returns risk? And nobody's raised their hand yet.
Wow.
So it's like, is this one of those risks that matters in practice but not in theory, which is a weird idea. Anyway, to get to the point, the most typical ways of measuring return performance are either the simple average. Mm-hmm. So you got a bunch of returns. It doesn't matter what order they come in. You're going to have the same simple average, or the geometric mean, which if you compound that becomes your buy and hold return, which is kind of self-explanatory. Mm-hmm. The geometric mean, same story. You got a series of monthly returns or annual returns. Doesn't matter what order they're in, you get the same geometric mean. So return sequence risk says, okay, you got a series of returns. Let's reorder them. As soon as you bring into the equation that you're either adding money periodically or withdrawing money periodically or a mixture, the sequence of returns does matter. Mm-hmm. And we illustrate it in the paper. In the more recent, less technical version, I illustrate it using the most recent 25 years of stock market data. And take those actual returns the last 25 years and put them in a different order. You can more than double or have, depending on which way you're looking at it, what withdrawals you might have been able to take, depending on what order those returns came in. So one of the things we're trying to do is get people to start thinking about this. I think a lot of smart people who could potentially contribute have not been thinking about this, and we'd like to get them thinking about it.
Well, we think about it all the time, Hank, because retiree that gets great returns over the next 30 years, but the first 10 years are disastrous, is not alive and doesn't have as much money when the returns do eventually show up late in retirement. So, it's something our financial planning software definitely looks at. Andy, any follow-up questions on that paper on investment returns?
Yeah, I could maybe go forever on this one. It's because it's fascinating. But so I think your paper looked at keeping your initial investment the same at the end. What if you had, could you be more aggressive, right? In other words, what if you were targeting, say, I don't need to have $1 million at age 92. If I have $1 million at age 65, I only need half of that. Does that change the outcome for an investor?
Yeah, it'll change the numbers. Although fortunately, the formula that's in the paper is easily adapted. So if anybody wants to see the formula actually shows up in the Financial Analyst Journal paper and also the more recent non-technical paper. But if you happen to pull that formula up, in the numerator, the formula has -1. Mm-hmm. Where that -1 is, the 1 is how big do you want your final balance to be compared to your initial balance. If you want a different ratio, if you want it to be 2 to 1, you just put 2 there. If you want it to be half of your original, you just put 0.5 there. If you want to spend it all down, just put 0 there. So the formula is actually easily adapted to alternative goals.
Excellent.
Well, Andy, let's now switch over to the wild, wild west that is the investment marketplace today with ETFs that you can double, triple the returns. Andy, do you want to ask some questions about this with individual stocks? Because to me, this is like, I never thought this would happen, Hank, but go ahead, Andy.
Yeah, I think what Kevin was alluding to is your research on what we call leveraged single stock ETFs, which to Kevin, I agree, it sounds crazy, but maybe for our audience, kind of help understand what that is and what your research is finding.
Sure, happy to. So this product class of levered ETFs has been around, I think, about 20 years now. And the basic idea, so it started with stock portfolios. I think the QQQ I believe QQQ might have been the first one, which focused on the NASDAQ market. But it basically says, we'll give you a multiple of the return, the daily return on a particular asset. We can give you 2 times the daily return, 3 times the daily return, or, if you want to go the opposite direction, we can give you the opposite of the daily return or 2 times the opposite of the daily return. So that's the goal of this product class. They've been around for about 20 years. And then more recently, so the original products were on stock portfolios, but more recently, we've got these being created for individual stocks. And I started my study 6 or 8 months ago, and I had, I think, 30 some odd in my sample. As I understand it, there's now 300 to 400 of these.
Wow.
With most of them have been launched since I started my study. So it looks like there's quite a bit of appetite out there for this product class. For me, it was just a natural thing because the prior papers about individual stocks, what made them interesting was compounding and skewness. Mm-hmm. Well, with levered ETFs, the compounding and skewness are kind of on steroids. And then you also have the people who provide this product. They have to trade every day to keep the multiple, the leverage, to keep the multiple at the target level. So you have compounding skewness and then the interaction of these daily rebalance trades with those. So it just becomes kind of fascinating from an intellectual perspective, but also has some interesting properties for investors.
Yeah.
Yeah.
Hank, I'll just say this for the novice, and I did try these at one point. I'm not proud of it, but not the ones on the individual stocks, like being aware that it's a daily reset is extremely important because a lot of people will hold these products long term. And so I guess I'll just ask you, and maybe you don't want to answer this one, but should anyone ever hold these products long term? That seems to be what's happening with a lot of investors, Hank.
Yeah, so I mean, I don't know exactly how long people hold these things, and I don't give investment advice, but I
Yes.
think even the vendors of these products discourage or at least caution people about holding these things long term. They say these are designed as a daily product; they're designed to give you a multiple of the daily return. And I think the underlying issue is that it's just complicated. I already touched on the fact that just compounding of random returns can be counterintuitive, but now you throw in these daily rebalancing trades, and it can be really counterintuitive how these things turn out. It's very natural to think, well, if this thing delivers 2 times the daily return, then it should over a month give 2 times the monthly return. And it doesn't. And the devil's in the details. There's a lot of formulas in the paper about that I put together, and I try to lay out, what is going to determine those outcomes. But it's not simple and it's not intuitive how it turns out. The one thing I could say for sure is that the skewness that would be there in any case is magnified. So, for somebody who really loves skewness, or call it skewness preference, call it gambling preference, it delivers skewness and it delivers the possibility of a really big outcome. But with all that skewness, most outcomes are below the mean. And then there's fees, and then there's the effect of the daily compounding, which doesn't have to work against you, but on average does work against you.
Yeah. So when you play the lottery, Hank, your money actually usually goes for people to be able to go to college. So with these, I don't know who wins, but it's probably the investment companies. But yeah, let's talk a little bit about flying, Hank. Now, you let us know that you actually have a pilot's license. Do you have a pilot's license now?
Well, I do have the license, but okay. I'm not currently certified.
Okay.
I've not done my biennial flight review in a few cycles.
Okay. So how did you get interested in flying, Hank?
Well, I've kind of always had an adventure gene. It shows up in various ways, like, backpacking and motorcycle riding. Although for anybody who, maybe I don't have to convince pilots of this, but, having an adventure gene doesn't mean you're reckless. Every mountain climber I know habitually wears their seatbelt in their car. It's nice. kind of like finance theory. You don't take uncompensated risks. But anyway, I've always had this adventure gene. The particular place where I grew up in northern Utah, the local airport was just a couple of miles away. I can remember as a kid, I received a telescope as a Christmas gift. I remember setting up the telescope in my bedroom window and watching the pilots take off and land at the airport a couple of miles away. And I said, I want to do that someday.
Well, that's neat. Yeah, that's neat. And that's the big misnomer, I think, about pilots is that pilots are not risk takers. It's all about mitigating risk. That's how you continue to fly. So that's really interesting that you put it that way in your description of that. Andy?
Yeah, I would say is a adventure gene. Is that, that's the life skew principle, skewness preference, maybe. That's one way to relate it to the research.
Yeah, I think there's some loose relationship here, though, having the adventure gene. But for me, the strongest parallel to finance theory is that you take risks when the payoffs are worth it, but you carefully manage your risk. You carefully manage the risk return trade-offs, and I think that actually carries over to many walks of life.
Absolutely.
So Hank, we're coming down to the end here of our time together. And so is there anything else that you think for just investors in general that you would like to mention of what you found in your own journey as an investor over the years?
Well, it's a big question.
Sure.
I think a couple of the most important things, it's kind of a trite phrase, that it's about time in the market as opposed to timing the market, but that's so true. And, maybe I've been lucky in a sense that I started investing in the early 80s, and with the benefit of hindsight, this turned out to be a really good 4 decades to be in the market. Mm-hmm. But the notion that you get rewarded in the long run in the markets, I think, is a strong one. At the same time, it's difficult to time the markets. There's other people trying to do it. The world is unpredictable. So time in the market is really important, and that ties into my research. It's all focused on long run outcomes, which is where I think we should be focused. I do think there's room to expand how we think about this. For example, the sustainable return is an attempt to go in that direction, expand how we think about it. But it's investing is about reaping that reward for bearing risk, and you reap that over time.
Yeah, well said, Hank. Thank you. Yeah. Thank you. So Andy is a former fighter pilot, and he's one of the few that doesn't actually mention that to you in the first 5 minutes of a conversation. But Andy, I'm kidding. We love fighter pilots. Andy, there's a call sign as a fighter pilot, and we've decided to always give our guests an honorary call sign. So first of all, Andy, what's your call sign, and do you have any ideas? I have an idea for a call sign for Hank, but do you have any ideas?
Yeah, mine means nothing. It's VizCap, which is, doesn't mean anything. Yes.
It's a long story, right? It's a long story.
Yeah.
I think you're too young for that to have been linked to VisiCalc, which was a predecessor of Excel.
Hank, it involved him punching out of a plane that was in trouble. But anyway, Andy.
Probably a good decision in the moment.
That's right. Hey, Kevin, what did you have? Skew? Is that what you were?
Yeah. So we think your call sign should be skew. I even thought about no skew, because that's what we all thought. Well, not we all thought, but many thought pre your work. And but Hank, it's really a pleasure to have met you again. I'm so excited because I actually searched the internet, found your data. It was actually helpful to me. It allowed me to better serve clients, and it allowed investors to have more knowledge about investing. So we're very grateful to you, not just for being on our podcast, but the work that you and your colleagues have done.
Well, I really appreciate that, Kevin. I mean, for me as an academic, it's hard to think of what's more gratifying than the work you did matters. So I appreciate it.
Yeah, absolutely. Thanks, Hank.
Thanks. Yeah. Bye-bye.
All right.
Yeah. Thank you so much.
Hello, Pilot Podcast family. Charlie here. I just wanted to share with you something we've just recently developed. In the show notes, you're going to see the Pilot Wealth Index. We want you to check it out, give it a shot. It's a quiz, a short questionnaire that allows you to understand, are you on track? We have a lot of people that say, hey, we just want to know if we're on track. Are we where we should be at this stage of our flying career, airline career, whatever it might be? How am I doing? Am I close to my peer group? Am I behind? Am I ahead? We've developed some questions, some metrics that we think if you go through this and check it out, answer the questions, you will have a very good idea of where you stand. We developed the questions that give an indication of, are you doing the right things you need to do to be prepared for an eventual retirement, and that one that can be profitable for you. So check it out in the show notes, the Leading Edge Pilot Wealth Index. We hope you give it a shot. If you have any questions at all, reach out. Happy to help. Charlie@leadingedgeplanning.com. Again, that's Charlie@leadingedgeplanning.com. You can call or text me on my cell, 865-328-4969. Thank you very much.
Thank you for listening to the Pilot Money Guys podcast. Please subscribe, rate, and review on iTunes or wherever you listen. We are grateful for your reviews because they encourage others to listen in. Visit leadingedgeplanning.com to learn more and subscribe to our newsletter. Leading Edge Financial Planning, LLC, LEFP, is a registered investment advisor. Advisory services are only offered to clients or prospective clients where LEFP and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.